5 days in a row, 6 days in a row technically, but all 5 days this week to the upside. 5 days in a row for the VIX to the upside. That's a pattern we have never seen before, and is a reflection of some rise and boiling pressure that is underneath the surface that aren't necessarily producing any kind of weakness yet. We did pull back a little today, so there's a little bit of weakness going into today. I'll talk about what my expectations are going into next week and after, but I'm also going to show you kind of these boiling pressures that are beneath the surface that once they bubble up, can cause some volatility, some turmoil, and I'll show you kind of some other past precedents of when we've had similar patterns like this before. I'll break down the sector rotation move, which did not look good today. I'll show you why, despite the fact that like the Russell was up great today, the Dow was up, and the S&P finished up. Though it was holding on for dear life at the end. And then we'll take a look at our trade ideas as a trade that's in the discretionary space that itself is not looking very good. I mean, breaking down today, which might be a precursor of what's to come for other areas. But we'll talk about how to trade that stock with its breakout pattern. So let's go ahead and get started. Today is Friday, October the 3rd, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, so again, today's video is free for everybody. The blog post is free every day. So if you want access to our kind of review of what happened today, all the news, everything that happened from a macro perspective and from a sector rotation standpoint as well. This is all free every single day. It includes the Market Outlook preview video that we do the other 4 days of the week. This is all free. Again, to get to access to this page, just go to marketscholars.com, click on Market Outlook Video Archives. You can see all of our videos, or all of our blog posts are posted here. Click on that. It takes you to this page where it will ask you to either log in if you're already a subscribed member, or if you're not, just click on this blue button to join for free. It'll take you to this page. Hit that blue button right there. That will get you access. So again, this link right here takes you to today's blog post. Click on that link to get there. Again, this is the page that will show up when you click on that link. Click on join free, subscribe for free. This link right here takes you to this page. If you want to just subscribe for free, get right straight to this page, click on join free. And again, that gives you a login to our site. Also gives you a free month. The first month is for free to our foundation tier. So if you wanted to subscribe to our foundation tier, our basic subscribers here, you'll see when you subscribe, you get a first month for free. So remember, subscribe on this page. You'll get the code after you subscribe on this page. All right, let's go ahead and start off taking a look at the S&P 500 with the market forecast indicators. You can see, again, 5th day in a row, all 5 days this week. So 6th day in a row to the upside, all 5 days this week up to the upside. So we closed yesterday at 67.15.35. We closed today at 67.15.79. So a very, very small gain as a result. We're short-term sentiments out of overbought territory, still in bullish territory. Momentum line's down, but not oversold. So this would not be considered a bullish intermediate confirmation signal. And we do end up with a little bit of a long upper shadow based off of how we closed the day today. So not the best close, but again, 5th day in a row. And I saw today too that you'll see in a second that the VIX was up 5 days in a row as well. And that combination, we haven't ever seen that ever in the history of the VIX index. We've never had a period of 5 days in a row to the upside on SPX and 5 days in a row to the upside on VIX, right? All but at the same time. So that's a first. There's always going to be first, right? That's a first for that particular pattern. Now, we are still 2% up above the moving average, so that's still fine. Market sentiment is still rising above the 80th percentile, so that's great. Intermediate line still rising above the 90th percentile. So again, we are not threatening an intermediate decline anytime soon. At least not like Monday or Tuesday. Now things can change on Monday or Tuesday, but as of right now, we are not threatening any kind of decline whatsoever. If you take a look at the NASDAQ 100, again, after getting a cluster yesterday, we were down today, almost 0.5%. So the momentum line's down. This is a bullish intermediate confirmation signal. Again, it would be better if the near-term line were not in bullish territory. if it were at least below 50, if not below 40, and it's not. See, the last time we had very similar pattern, it took a couple of days to the downside before we finally resolved that near-term decline. So that's my expectation on this one. I do not expect we'll bounce back up on Monday, and I expect that we'll probably continue this near-term decline. I told you early in the week that I didn't expect this near-term decline to continue higher for very long, not like the last one. And that's kind of what we're seeing. We're starting to see already more of a near-term decline here. The Dow Jones Industrial Average finished higher, finished a 0.5% higher. Again, long upper shadow. We had a long upper shadow over here, and that started that near-term decline. And we'll see if that ends up being the case here. The momentum line, it's about as neutral as you can be, 50.17. So pretty darn neutral there. The near-term line did break down below the 80th percentile, but still obviously in bullish territory. And we're not even down one day. So, we'll see if that continues. Again, the long upper shadow is a little bit of a concern there. If I take a look at the Russell 2000, same thing, long upper shadow. Its near-term line's actually still in the reversal zone. Momentum lines is barely crossing below 50. So the Dow and the Russell aren't nearly as bad. We ended up 0.75% higher. So this is mainly a Mag 7 decline that we had. Again, coming off of this low point, you'll see later, this is not the most bullish rally. We've only had like one day where the technology sector outperformed. The rest of this time, this has not been the greatest. That's, again, why I don't think it will last, why I don't think this will be a strong move. And we did get a new high on the Russell 2000. But I expect going into next week, early next week, we'll probably continue with this little near-term weakness. Again, now whether or not it turns into long-term weakness, like an intermediate decline, depends upon how deep the pullback is, right? So if the near-term line gets just like all of these, then we're fine. But if the momentum line drops below the 5th percentile and the near-term line follows, pretty deep as well, kind of like this over here, then if that happens, then we are likely to be in intermediate decline. So we'll just kind of keep an eye on how the near-term line falls over the next day or two. I don't expect it will drop down there because again, the momentum line's pretty over. So now, again, remember when we cross below 60, the question is going to be, do we cross below 60 and 50 or 40? Or do we, and where's the momentum line? Is the momentum line extremely oversold like this? Like, so on this day right here, now we did cross below the moving average, and that's unlikely on Monday. But the momentum line dipped below the 5th percentile. The near-term line dropped from 72 to 27. So it crossed below 60, 50, and 40 with an extreme oversold. So on that day right there, we only closed 0.25% below the moving average. But that was about as bearish of a first day move that you could have. Very likely to turn into something more, and it did. And so, again, do you see something like that happening this go around? We were 1.5% above the moving average at that point. We're 2% above. So it would take more than a 2% decline to get us below the moving average. I don't see that happening. Again, barring some kind of unknown catalyst that comes out over the weekend, I don't see that happening at all. Now let's take a look at the weekly chart here. And you can see, very, very strong week. We're 6.5% above the 30-week, or excuse me, the gap between the 10 and 40-week moving average is 6.5%. That's a very, very strong level. Not quite the 90th percentile yet, so not a green dot yet, but pretty darn close. We're well above the 10-week moving average, so we're not, remember, an intermediate decline, you need a red arrow on that 10-week moving average, which pretty much constitute a break of the 50-day. Remember how I said that you don't get intermediate pullbacks unless you break the 50-day. So obviously we're nowhere near that. Very, very strong week. Weekly chart there. If you look at the weekly market forecast chart, again, continuing higher, the intermediate line's at the 98th percentile. Like, this has been a strong run above the 90th, but it's been a strong run too above for that matter, above the 95th percentile. Like, we've had some runs, this one here, in 2024 coming off the 2023 low, we got above the 95th percentile there, 1, 2, 3, 3 barely, and then we dropped back down. Then we got back above. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, and then we dropped below it. So we had 12 weeks there Well, here we are now getting above the 95th. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 weeks. Very, very strong move. Needless to say, a very strong move. And again, unlike 2021 when we had 0% interest rates and QE coming out of COVID and stimulus checks, and you had a lot of stimulus, a lot of monetary and fiscal accommodation there, and high levels of inflation helping drive prices of everything higher, including stock prices. We don't have that now. It's a much different situation now. The Fed is cutting rates, but they're not at zero, and nor are they expected to be anywhere close to zero. We might get a couple more cuts, and that's it. And yet, we are strongly bullish. You can see in this case, over the last 5 years, we are in the upper decile in terms of being above the 30-week moving average. So strong run. And then if you look at the whole moving average, which is what we're watching very closely, you can see how close we are to the 200-day, which is why we're, again, like breaking the 200-day hole is usually a pullback, right? So, that's how close we are. Like we are subject to a pullback at any time. Though again, probably not Monday or Tuesday. We'll see how this near-term decline turns out. But look how close. Again, we're only 5%, almost 6% above the 200-week hole, which breaking that typically coincides with corrections, pullbacks that turn into corrections. So that's our concern. If we get a 5% pullback, great. We stay above the 200-week moving average. We bounce. We continue higher. Fine. If we have a 10% pullback, now we're incorrect. We have a double dip correction, right? 2 pullbacks in a row that both turn into corrections because of, again, how close we are. But you notice again, we're above the 20-week hole. We have to, for an intermediate decline to play out, we have to flip the parabolic SAR, which is at 651. That's 18 points below us. We have to flip that to the upside, and now granted it's going to be higher next week. It gets higher every week, but we also have to be below the 20-week hole at 663, and we're 6 points above that currently. So again, next week is not going to be the beginning of an intermediate decline, at least not according to these weekly charts. Now, could it be a transition week next week? Sure, but even that's unlikely because of how far above the Hakunashi close we are. So I don't even think next week's gonna be a transition week. If anything, it might be a lower close. That would lead into a transition candle the following week. But I think next week, again, I think we get a near-term decline. But I don't think that will lead to the intermediate decline. I think we'll just bounce right off of it by the end of the week like we did this last one, and we'll continue higher. That would be my expectation going into next week there. Looking at the 3 green arrow chart, again, 3 greens. The Qs got a red arrow because we were down the most in the Qs. We did finally get enough 3 greens on the Dow with that long upper shadow. We have not quite yet. That's how close we are to getting the 3rd green on the Russell. So that's something to kind of keep an eye on there. If I look at the 2-line version of that chart, again, we just kind of so bullish here, but we're still easily above the 8-day. And again, I don't think we even break the 17-day. We might break it a little bit, but I don't see us like breaking the 17 and the 30, right, which would lead to intermediate decline. So I think we just kind of gradually move towards the 17-day, maybe close a little bit below it, and then bounce back up. I think that would be our worst case scenario that I expect next week. Otherwise, the best case scenario is that we don't get a near-term decline. We stay above the 8-day all week, right, and just continue to move on this current near-term trend. That would turn this from a 6-day near-term rally into an 11-day, which is unlikely. I don't expect that, but that's, again, that's what we saw before. So doesn't mean it can't happen again. I mean, you can see this week, we weren't even up every day this week, and we stayed above the 8-day all 5 days. So that's what I'm talking about in terms of, that's probably our best case scenario next week, with our worst case is kind of doing this again, what we saw. And obviously the worst case is breaking down, but I don't see that as a strong possibility. I see that as a very low probability next week. Let's take a look at some of these other oscillators which support that. You can see the negative or positive DMI is well above 30, still rising. Negative DMI is well below 20, still falling. So your ADX now is crossed above 25. So on Monday, we're going to be back to a dark green shading. The weekly, you can see the first time the positive indicators crossed above 25. The negative indicator has been below 20 for a long time, but this is the first week we have closed below 25 or closed above 25 in a long time. And there aren't very many instances when we get above 25 that we stop. That one we got to 24 and a half, and we were in a bearish trend. I guess we were kind of in a bearish trend here, but we were obviously well out of it by now. The negative indicator was way down at 14. This one was, it's lower than where this one was here at 15, almost 16. So, for us to get, when we break above 25 for the first time after some weakness here with the ADX below 20, usually it kind of keeps going. So there's that possibility there. If I look at the RSI and the CCI, they, we're still easily above 60 on the RSI, and we're still easily above 100 on the CCI. So those trends continue to be strong. The weekly trends as well. I mean, we're above 70 again. Last time we got above 70, we continued higher all the way up to almost 80 both times. Now, there's been other instances that we got above 70, but again, none of those really turn into immediate downturns. You notice the weekly is finally getting up to 150. So it's finally starting to make a run on that particular indicator. The Ichimoku cloud, I told you yesterday we broke above 20 yesterday, where we're still above 20 now. So that's a good sign from a trend strength standpoint. We had crossed above 5 already multiple weeks ago. Now we're working our way up to 10. So that's a good sign as well for the markets, right? You can see you get mature on the weekly trend, you can really get going for a long time. Whereas over here, we never got mature on the weekly trend. In fact, the weakest mature bullish trend that we had would have to be like this one right here in 2010, when we were still in a correction. We were still below the 200-week moving average. That looks like to be the weakest one compared right now. Otherwise, this one was the weakest one, and then this is the one that we went, really strong into. Like, we got all the way above 10, all the way up to 12. So we're just at 7.5 right now. So even that says, there's still some opportunity here. As bullish as we are right now, there's still some opportunity. And finally, looking at the Bollinger Bands and the Keltner channels, we closed near the upper Keltner channel, but the momentum is waning, still in the upper quartile of the bandwidth. If I take a look at the weekly versions of this, we are in the upper quartile of the weekly Bollinger bandwidth and above the upper weekly Keltner channel. With, granted, it's declining momentum, so the bands are moving, falling, but then, we're still bullish, right? That's still, until we break that, that weekly Keltner channel, we're still very strongly bullish there. Finally, let's take a look here at the intraday moves. You can see a higher high and a higher low, but we came down, right? Later in the afternoon, we fell and finished the day below yesterday's high. We did not finish the day below yesterday's low, nor did we finish below last week's high. So we got a higher high and a higher low on a weekly basis. We closed above last week's high. So really bullish from that perspective. Again, we got a new high today, so we're still at 100 there. And, again, that new low will move up on Tuesday. So this will be the new low on Monday. So on Tuesday, and then Wednesday here, and then Thursday we're looking at, let's see, 654.30, and then this one is 654.41. So let's see. So this is Monday. This is today. Mondays, Tuesday, Wednesday. So on Thursday we'll meet up here. So today, Monday, Tuesday, Wednesday, Thursday. So we'll move up, and then Friday, Monday the following week, Tuesday, and then this one will be the new low on next Wednesday, the following Wednesday. So for the next week and a half, that's kind of the trajectory of the 4-week low point. It's going to move up every day next week until we get to Thursday, and then we have a few days, and then, like I said, the following Wednesday, it will, move over here. So, and it won't move at all. It won't move at all for a long time after that, unless we get new lows. So that's really going to bring, again, the range down. So it's we'll need new highs, and we've done this before, right? We've come off of this before with new highs. We just barely did that in the last near-term rally, and so again, that can happen again, and we'll just kind of keep our eyes on that. Today's range was relatively small, below the average. Where's the volume? The volume was right at the average. So the money flow, the volume still remains strong. You can see, usually when we're bullish, like the volume really tapers off when we're bullish, and that's not been the case, right? We've been actually rising here from when this thing started. This is when the bullish move started. We fell initially, but then from about this point, we've been really bullish, and yet volume is actually higher than that level. And you can see the ATR is 0.74, so that's extreme lows. It's not as low as it's ever been, but it's anything below 0.8 is extreme. So we're really grinding from that perspective, but that volume is helping keep the money flow in check, right? Still hovering right at the bottom, but still in bullish territory with some pretty good money flow there. And then finally looking at the VIX, like I said, the VIX rallied today, so not by much though. So the VIX was up 5 days in a row. The S&P was up 5 days in a row. That's why your correlation right now between the VIX and the VVIX, and the S&P, excuse me, is still positive. Remember, it's typically very negative. It has been pretty positive lately, and it still is positive. So that's why it's positive there. And then you look at the VIX, the correlation with the VIX and the VVIX, which is, right here. That correlation's still positive, but very weakly positive. And that combination of a positive correlation of the VIX with the S&P and a weak positive correlation with the VVIX typically suggests that the VIX is scheduled for a strong move to the upside. The other thing, too, that would suggest that is that the range this week on the VIX, we finished this week with a 1.5 point range on the VIX. That's a very, very small range. And you can see, as of right now, the not the quarterly, sorry, the options expiration range is at 2.5 points, which again is the last time we were at, like really low levels, that typically coincides spikes in volatility. So that's a very, very low range. And to have 1.5 points, 2.5. I mean, the ATR is at 4.25. We haven't been over that ATR since really close to it, at least since early September. We've just been grinding to the downside, and it's way down itself on a daily basis. So the compression of volatility, the positive correlation with the S&P, the weak positive correlation with the VVIX, and the fact that it's really like, here's another way to kind of measure the volatility of volatility. The bandwidth is really, really low. Like you can see when the VIX spikes, but when you look at, the volatility of it over, like, say, the last 5 years, we are really low. And you can see that typically, again, as we saw back in 2024, leads into a jump in volatility. So there's a lot of factors right now that suggest that a jump in volatility is coming. That would be an intermediate decline, most likely. But again, not like there's a lot of potential energy building. And once it's activated, then it can convert to some tremendous active energy. But there's got to be a catalyst that makes that switch from potential to active. And right now, it's just storing a lot of potential. And the more potential energy that builds up, unfortunately, the stronger the active move will be. And so that's why it's a little concerning there that it might not just be a 5% token pullback. I from a technical perspective, not knowing anything about this VIX here, from a technical perspective, a 5% pullback seems the most likely, right? There's a lot of support there. It's down into this 635 level. I mean, that would be a very easy 5% move from a technical perspective. But considering the volatility, then a move down to 600 is very likely, right, with all that potential stored energy. And again, like we would probably hold there. We wouldn't fall below that, at least initially. But it would make the subsequent bounce, like we had right here, likely to fail. And then, of course, now we have our correction, and so that's the problem with when you have, like the VIX doing what it's doing, the options market and the skew being as high as it has been for so long is, it's again another idea of this more potential energy stewing below the surface, kind of, it's like a lot of pressure stewing below the surface. All it needs is something that, like a little pop, to start to release it, and then it explodes, and everything else blows up. Now, I'm not talking about like, again, bear market, like we're going to fall 50%, or like a COVID style drop, but again, just enough of a break that you get that big strong near term decline, and then it's like, oh, and then now we're going to intermediate pullback, and then it's like it continues to really boil to where the intermediate pullback is more closer to 10% than 5%, and now like, oh, great, now we're looking at a correction, right? And to get a double dip correction, but not, again, considering we've had 7 corrections since our last bear market, like at some point in time, a correction is going to turn into a bear market. We don't know when. 7's actually a lot. I think I've seen 8 before, but 7's a lot. So yeah, we're very mature in this trend, and it's just a matter of what's going to cause that pop, just to start releasing some of that pressure to where the rest of it can start to slowly break out itself. All right, now let's take a look at what's driving this price action. Look at this move on gold in 3 months, 15.65%. That's a strong move to the upside. Let's take a look at gold here on the rate of change. This is just 26 days. 3 months, of course, is 63. So let's bring that up here to 63 days. Rolling window. There's your 3-month report. So again, it's not the highest. Over here, coming out of April expiration, we were over 25% higher on a 3-month basis. So it's not the highest, but it is one of the highest moves that we've seen here lately. You can see there's some other 3-month returns that were just so dramatic to the upside. And there we go. So again, you can see, we had a pretty good run on gold there, and the S&P this is the S&P 500 in purple. After that 3-month run, you can see we had a pretty good run on stocks as the return for gold came down. And over here, you can see stocks were actually declining during that run on gold to the upside at the beginning of this year. Was one reason why gold was so bullish. Over here, you can see stocks and stocks and gold are both rising together, similar to what we're seeing right now. And in fact, here, let's do this. Let's add on a correlation here, and so stick that into a 63. There we go. So again, going back to this move over here, the correlation was relatively positive, and then that led into a weakness. That there was the banking sector that kind of broke down there. And then on this run right here, you can see it was right around 20% positive correlation, and we ended up the stock market rallying out of that. And of course, during this run, we were a negative correlation, and that was during the decline. So here we are here. This is probably the most positive. I mean, we are that strongly bullish on gold. And we have to go back pretty much to June of 2021, where gold and the dollar and the S&P were both rising because we had a 7. I mean, right now we're at, what are we at? 90, 80, almost 90% correlation. Back here we were in the 70s. And you can see that eventually led to some continuation, with, again, 0% interest rates and everything else, but eventually a pullback and then a correction there in 2022. So it's probably not the best scenario to have gold performing so well with such a strong correlation to the S&P 500. And with both of them moving up so as high as they are right now, it's probably, again, not the best combination there, but that's what we're getting, right? That's what we're getting on the asset class comparison. And if I take a look at this week, remember that the near term rally started last when did the near term rally start? Was it last Friday? Started last Friday was when the near-term rally started. So let's go back to here and go back to our last Friday, which was September. I'm going to go to a 5-minute chart. So this will include all of this week. There's the strength in the S&P. Obviously, IWM is actually outperforming this week. Emerging international stocks are clearly outperforming this week. And we know what's been driving this near-term rally: weakness in yields, weakness in the dollar, weakness in commodities. All three things, all three factors really lifting us up. But, again, the weakness in the dollar really pushing gold up. So, and again, stocks are up so much and gold is leading and international equities are leading, then you can see that what that tells us is most of this rally in the S&P has mainly been because the dollar's been weak, and really nothing more than that. If I were to go to the dollar index, let's take a look at the dollar and see what it's doing. You can see again, it's been on this near-term decline. It's about as neutral as it can be right now. Very, very flat. And we've looked at this before, but the Bollinger bandwidth for the dollar is really low. Like it got extremely low with new 150-day lows. Then we had a little bit of a pop to the downside, but now we're right back, again, to a bandwidth that's way inside the Keltner channels and is extremely, extremely low volatility. And you can see that as well in the ATR, for an example, especially the normalized ATR, how low it is. I mean, it's about as low as it's been since back over here when it started, when it really kind of broke out to the downside. Again, it doesn't necessarily mean we have to break out to the downside here. It's been lower than this before, but when we get to these lows, it typically precedes a strong move in one direction or the other. We had the big move up over there on a normalized basis during this bullish rally, and now we've really been coiling on the dollar to the downside. And of course, commodities got that bull tag yesterday. Still kind of hovering around that. Let's look at the market forecast. It's still kind of hovering around that bull tag level. So looking like it could bounce. Now, crude oil, which had a really bad week here, really, really rough week, ended up higher today, but that didn't stop it from having an oversold cluster. Again, we haven't had an oversold cluster since February of 2025, and we were clearly and when we had been starting an intermediate decline. And that turned into a correction, if you recall. So we've been in dark pink shading in a red line for so long. Remember, strong growing economies need commodities to grow those economies, and especially with the electricity demand that typically comes from a lot of different sources, but energy is one of them. And so the fact that energy is not very much in demand right now, is closer to breaking 60 than it is breaking 70, then that tells us a little something about the underlying fundamentals behind what's going on versus, say, just plain old investor sentiment, which has been so strongly bullish that might be we're kind of losing the substance behind the flash, so to speak, in the markets. Let's take a look at the breadth, which is another, again, underlying cracks in the below the surface. We're still negative. I mean, it was a good day today, generally speaking, in terms of, let's pull up some of these other stock charts that we look at. It's not showing up here. All right, for some odd reason, I lost a lot of those charts. But if you look at, okay, let's say the number of stocks above the 50-day moving average, back above 300, big move there today. Number of stocks above the 200 days, still kind of hovering around 337. Number of new highs today, back above its average, 162. That's not a lot, but it's enough. The bullish percent index up at 61. So this is the weekly average. It actually is above its daily average, barely, but above its daily average. So we are getting, and here's your net. The trend. Here's your net new highs and lows. Big jump up to 563. So big move higher. Remember, the markets dropped by the end of the day today on the S&P from the Mag 7 standpoint, but everything else, it was a big, big, broad move. And again, that's a big discrepancy when you have such a disparate move here. When you look at the sectors and how they're performing, here, let's just go to October the 3rd. October the 3rd here. That's not the most bullish, right? The markets are up, finished the day up, but for most of the day, your most important sectors were below the S&P 500, and then they all three finished the day negative. Right? I mean, these are the sectors we need to be rallying, not utilities and healthcare. And they ended up being down the most. If I were to go back to the beginning of this near-term rally last Friday, again, healthcare and utilities are our two best performers. Technology had been, pulling back a little bit. Now it's like right there with materials and industrials. And discretionary is barely positive. Communication services is negative. Of course, energy down there, which I don't mind energy being below the XLK, but we don't necessarily want it to be negative either. So this is not the most bullish pattern, and especially, again, what we saw today with our most important sectors down. Now granted, we still, technology was down, and it lagged behind. Um, it lagged behind energy, right? And that's a really important relationship that we've been paying very close attention to. So if I were to come down here, um, to, let's see here, this ratio right here, and look at energy, XLK relative to energy. Remember yesterday I told you that we kind of like seemed like we, another time instance like last time that we kind of had a blow off top. Well, here we are already down. So that continues to go down next week. Then we have our near term decline. And that's what I expect. I expect that would be the case. I was very skeptical of this kind of blow off top move yesterday, and I feel like that we'll probably end up with another near term drop where we come back down towards that 50-day moving average again. All right, well, that brings us to our trade idea of the day. Let's pull up the platform here and take a look at one second. Las Vegas Sands. Here we go. So let's pull up the market forecast. This is in that discretionary space, but it really broke down hard today. Dark pink shading in a red line, closing below multiple weeks lows here. Definitely closing below that bull tag low that we just barely got. The intermediate line has been below market sentiment for quite a while. We've got multiple near-term moves, but this is a pretty bearish near-term decline. Obviously, with how bearish, 7% drop that we had today. The intermediate line's back down now, back into bearish territory itself. If I look at the weekly chart for Las Vegas Sands, you can see that we are below the 10-week moving average, hence the red arrow. We have a transition candle that's actually a bearish candle. So that means next week's candle most likely being bearish. The PPO is rolling over right now. If I take a look at the 3 green arrow chart, we obviously have 3 red arrows, but not the 3 red arrows you'd want to buy because we already got a red line that we're that far below it. Again, closing below multiple lows. A big volume move today, 1.5 times the average volume. We're breaking below not just the 30-day, but pretty much every moving average except for the 200-day. We were above them all yesterday and breaking below all of them. So we're well below the 50, working our way now down towards the 200, breaking the point of control clearly as well. You need to break that, to break that much support, you need a change in sentiment, and obviously we got it from a technical standpoint. Let's take a look at some of these other oscillators. Like the DMI, you can see we are above 30 on positive or negative indicator, below 20 on the positive. So big breakout move there. The ADX is starting to rise. The RSI and the CCI, they're breaking down below 40 on the RSI, below minus 100 on the CCI. The weekly CCI is breaking below 0. So that's a significant change. If I look at the Ichimoku cloud, we're breaking into the cloud. You can see that we don't have even a weak trend developing, so we're very new, very negative rate of change there. Looking at the Bollinger Bands and the Keltner channels, we are obviously closing below both the lower band and pretty much the lower Keltner. Oh, we ended up closing, well, slightly above the lower Keltner channel there. So we were flirting with it throughout most of the day. The momentum just was barely positive. Now it's turned negative, so it's just barely negative. Again, we don't have the green dots yet. We had, green dots over here, but the bands are inside the Keltner channel. So, obviously, it most likely is going to expand. The bandwidth is low and turning higher. So I think we're starting a move. So what I decided to do here was to do a long vertical spread. So sell the relatively, like instead of going to the low 20 delta, because that gets down to 45, gets down to like where that 200-day moving average is. So I didn't want to have to break the 200-day to get to my, so I did the more conservative 47.5, bought the 50 position sizing for a full position size, a little less than $500, and getting a little more than about 1.7 to 1 reward to risk ratio. So a little bit more than 1.5. You can see it's already working in our favor since we put it on during the Market Outlook Live. So that's, remember, the foundation members get access to all of these trades. We do one every day, but they also get access to the Market Outlook Live, where we put these trades on in real time before the market closes, as well as managing all the old trades. We got, I think we had like 12 trades still left for October expiration. quite a bit. And most of the ones that we have left are the ones that are actually still holding gains or very small losses. So we actually have a really, really we've got 2 more weeks, so things can change. But as of right now, we have a good October expiration coming up for us here with the trades that we currently have. And this, of course, is November expiration. And so far, we got a good start to November. All right, well, that wraps us up for today. Thank you very much for watching. Remember, if you want access to that full video every day, today is free Friday, but if you want this video every day of the week, including the Market Outlook Live, the Market Outlook Live Trade Tracker, where we track the results of all the trades, you click this link right here. That takes you to our foundation page where you can subscribe. Just $29 a month. No commitment. You can cancel anytime. Of course, if you want to do the year, it's only $299 a year. So you get 2 months for free when you do the yearly plan. But you get access to all of that, right? And we're doing pretty well, including the October expiration, which, like I said, got 2 more weeks left. So things can change in 2 weeks. But as of right now, we're up like $12,500 across all the trades over the course of this year. And again, on directional trades, we're only putting $500 at risk, and the non-directional trades or the more higher probability trades, we put $1,000 at risk. So I think the most we've ever had at risk at any one time is less than 15,000, and we're up 12,500. So it's been a really, really good year, and makes the cost of these videos well worth it, considering that if you do the yearly plan, it's only $1.20, about $1.20 per video. And like I said, making $12,000 over the for first 9 months so far, because again, things can change in 2 weeks, but the first 9 months of the year to make $12,500 and only costing $1.20 a video, or $1.40 a video if you do the $29 a month, is well worth it. I mean, like I said before, a lot of our clients have said that they make enough from these videos to cover the cost of their premium services that we have at Market Scholars. So again, that's available to you, that link I showed you. Thank you again for watching. Subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, follow me at DavidSettle42 for more content between the videos. Have a great rest of your weekend, everybody. We'll see you all on Monday.